We are in the thick of summer where temperatures may be on the rise, but inflation is steadily cooling off. Meanwhile, fixed income remains attractive and equities, well, they continue to perform well. Why? And where is the recession that we've all been expecting? We're going to break it all down for you right now here on UBS Trending. Hi, everyone, and welcome to UBS Trending. I'm Anthony Pastore. Thanks for being here with us. Leslie Falconio and Dave Lefkowitz are joining me here in the studio. Of course, they are from the Chief Investment Office to break down the latest CIO house view. So good to have you both here in your respective chairs. David and Leslie, good to see you. Leslie, I want to start with you, and let's start with what's going on in the fixed income space. It's been a really interesting market for equities as well. But since we're talking with you, we did just have the July Fed meeting, and as we know, Chair Powell did raise rates, or in the rest of the FOMC, by 25 basis points. But just want to get your takeaways and what you saw as the market's reaction to that.
Well, I mean, I think it was so well priced in prior to the increase. So now we're at a place where the Fed fund rate's the highest it's been since 2001. And what the market was really looking for was the Q&A part of it. And actually, he really started to focus on, as we expected, that data dependence. So he has to leave the option open of a potential one more rate hike in the fall, possibly, because as we know, when he did the economic projections, the meeting prior, he actually did indicate that there would be two. So I think it's really up to the data dependence over the next several months. But the shift that we've really seen, and obviously since that time, we've had some very good PCE numbers, and ECI came out better than expected, so that's on a positive note. But I really think the biggest shift that has occurred has been what is pricing in for 2024. And what I mean by that is the market had really accepted the higher for longer for 2023 and adjusted that the Fed would hike, they did maybe one more time, but they weren't going to ease. And now then the focus came to what would happen in 2024. So how much truly longer would that higher for longer be? And if you even look in the beginning of July, the market was pricing in about 160 basis points of easing in 2024. Well, today that's down to about 120 basis points. So it's really started to converge to what the economic projections from the Fed had dictated, which was about 100 basis points of easing in 2024. And when we think about the 10-year going forward, that part of the market or the expectation of that easing is really going to be a big guide, because now obviously we have interest rates up to around 404, 405 in 10-year yield, but it's part of that has to do with the removal of the easing. Part of it is because of the BOJ, stronger growth numbers, big supply. So I do think that that's really going to be what people are looking at, how the market prices in and easing. And I do think this time around with his Q&A, he was very clear that there's not going to be an easing in the near future, unless of course, there's some sort of fat tail event within the economy.
Right. You made a point about saying that people are really looking forward to the Q&A portions of Fed Chair Powell's the Fed days, because the Fed meetings are so highly anticipated almost every time. But what's he going to say in the Q&A? And look, as we're going to talk about in a moment, there are so many attractive opportunities in fixed income. But we'll get to you in a minute on that, Leslie. So David, the story really is equities here, right? I mean, I don't know. I mean, why are they just performing so well? I know we've got, of course, those 7 tech stocks that are sort of rising the tides for all boats, but what's really the story here and the equity side?
Yeah, so Anthony, I think there's been 3 main factors that have really driven the very strong gains. And just to level set, like the S&P 500's up basically 20% year to date. Even more impressively, the NASDAQ, which is obviously very tech heavy, up nearly 40% year to date. Now, this is kind of a mirror image of what we saw last year, so it's just sort of somewhat compensating for some of the declines we saw last year, but obviously very strong gains. I would say there's really 3 factors. Probably most importantly has been a favorable shift in the growth and inflation mix. And what I mean by that is that economic growth has proven to be much more durable than what most investors expected. And at the same time, inflation, as Leslie was talking about, inflation has been coming down. So that's a pretty equity-friendly backdrop. And we're just to underscore the growth component here, we're in the middle of earnings season right now, as you probably know. And yeah, the earnings numbers are coming in decent, and just kind of confirming that we're probably seeing a bottoming in earnings growth for the S&P 500 as we speak, and things are going to start to look a bit better. So growth and inflation. The other thing is that I think a lot of people were just very cautiously positioned, right? There were a lot of concerns about the recession that was going to come. That pushed a lot of cash to the sidelines. It pushed people into more defensive parts of the equity market. And because we haven't gotten this recession, it has been forcing people back into the equity market. And that has really been propelling the markets higher to some extent. And then lastly, you talked about the 7 tech stocks that have been leading. I mean, you can't talk about 2023 without talking about artificial intelligence. And look, some of this is legit. I mean, you're seeing a lot of spending going on to build out the infrastructure around artificial intelligence.
Yeah.
A lot of companies trying to reorient their business models to sell AI products, and other companies that are getting excited about using them. So there's been a host of factors: growth and inflation, positioning, and AI.
Yeah, it's such an interesting market. So where do you think we're going to go from here? What's your outlook for the rest of the year into 2024?
Yeah, so I thought it was helpful to sort of set the stage of what's been driving the markets, because I think now we can now focus on probably the more important question is, what next?
Where are we going?
And yeah, so look, if you think about that growth and inflation mix, I think there's a possibility that begins to shift, right? That we eventually start to see the lagged effects of the Fed rate hikes. We start to see the economy slowing down. I mean, certainly Chair Powell thinks we probably need a period of slower economic growth to really get the inflation fully controlled. Or if that doesn't happen, we could see a period when the inflation readings start to become a little bit more sticky, right? You get faster economic growth,
right?
Probably leads to a bit stickier inflation. So that shift in the growth and inflation dynamic, could shift in a less favorable way to equities. On top of that, we also have to recognize that valuations are also now pretty full, right? The S&P 500 is now trading nearly 20 times earnings. I mean, that is pretty elevated from a historical perspective. In fact, it rarely trades above 20 times earnings if you look back over the last 60 plus years. So a lot of good news is priced in. So, in our view, we think markets don't have hard to see a lot of upside. At the same time, we acknowledge that the hard landing risks do seem to have receded. Mm-hmm. So at the same time, maybe there's not a lot of downside risk either. Probably means more of a range-bound market, a period of digestion of the gains that we've seen so far this year.
Yeah, and you could feel there's trepidation out there, I think, from investors for exactly what you said. It's there's sort of like how much further can we go, and we're all watching what the Fed is going to do. We're obviously watching rates, and we're seeing inflation kind of come down a little bit. So Leslie, on the fixed income side again, we've got total returns sort of sitting in positive territory, but at the same time, you've got lower credit quality outperforming. What's the story here, and how do you position as a fixed income investor?
Well, I mean, I think that the fact that yields are up from the beginning of the year in 10-year, and you still have, positive total returns for even the higher quality assets, just really shows how important carry is, or your yield that you're earning to investors. And really that will be the tailwind to total return for the rest of the year. When you think about the lower quality side, say like high yield, what's interesting about that is that a lot of that outperformance has sort of come in very short spurts, meaning that in January it was up 6%, then we had the financial instability, which caused some headwinds, but once the Fed acted so quickly, we saw that market recover very quickly. And when we think about our positioning right now, it's not as though we're expecting some kind of catalyst in the lower quality assets, but we remain neutral. We remain neutral in high yield. We remain neutral in senior loans, simply because we don't believe that you're being compensated enough for taking on that risk. And frankly, because of what you're earning and carry for higher quality assets, given where we are in the credit cycle, and you don't need a recession, you don't need a hard landing to actually start to perform in these higher quality assets, because you are earning that kind of carry, then we just think it's a better place to be. I mean, what differentiates, today's kind of, expansion from that COVID recession is this isn't about, relying on debt or aggressive lending or overly inflated asset prices. This tailwind has been about employment.
Right.
And so I think that part of that has really allowed some of these lower quality assets to perform very well. And again, we don't think there's going to be a huge fat tail event. We just think as when you look at relative value and opportunity, you're just not compensated enough. So what we did, though, with that said, is that instead we mixed our high quality assets with having it preferred in the preferred category, and we did that in May. So we actually started to have a mix within high quality, and that a sector that has a higher correlation to the equity market, is a hybrid between high yield and investment grade corporates, to really add a little bit more to our risk, and that actually has bode well for us, given how well that lower quality has performed in the past couple of months. And we're going to keep that on along with our higher grade.
Great, Leslie. Thank you very much. And David, we're almost out of time. We've got about 30 seconds. But on the equity side, where do you see opportunity right now from a sector perspective?
Yeah, so our main message is focus on the laggards in the equity space. So from a sector perspective, the top of our lists are within cyclicals, I would say energy and industrials. Energy actually sort of been quietly outperforming over the last 6 weeks. The oil markets are starting to tighten up. Demand's been robust. OPEC's cutting supply. We think there's more to go in terms of oil prices rising, and the companies are generating a tremendous amount of free cash flow. Within industrials, there's a lot of nice secular drivers. You've got the infrastructure bill. You've got onshoring, reshoring, Inflation Reduction Act, defense spending, aerospace spending. I mean, there's just a ton of kind of interesting trends going on there. Hasn't kept pace with the market so far this year. We think it's worth a look. I would also, you want to have a little bit of defensive exposure in this environment. Still a lot of uncertainty in the macro landscape. So focusing on consumer staples within defensives. And then we like the equal weighted S&P 500 versus the market cap weighted, just thinking we're going to see a broadening out of the performance within the market. Again, focusing on those laggards. And we still have a small preference for value stocks over growth. Just growth stocks are just very expensive at this point.
Terrific. And just really quickly, one word, are you, well, maybe you can't say it in one word. Tech, are you avoiding tech at this point in the story?
So we are underweight tech. It actually has slightly underperformed in the last 6 weeks, but it's been a huge outperformer, obviously, this year. But as we speak right now, we have a least preferred view, largely because of very lofty valuations at this point.
Terrific, David and Leslie. Thank you. Always good to be here with both of you and for catching us up on the August House View for CIO. Good to see you both. And thank you for joining us as well. For more information, you can visit our Insights page at ubs.com/views, and make sure to follow us on social media, LinkedIn, Facebook, Instagram, particularly there at UBS Trending is our handle for all UBS Studios content that you can find here and also content that you can't find anywhere else. And as always, if you have any questions about your own portfolio, speak with your financial advisor. Until next time, I'm Anthony Pastore. Have a great day, everybody. Remember to keep your eyes on what's trending. See you soon.